Can you hear me?
Yes, sir, we can.
Good morning. How are you guys doing?
Fantastic. We're really trying to follow up with the classroom today, sir.
I wish I would have known this. I only checked it out because someone replied to me saying spend a little bit extra time on your in your space right now. I'm like, wait a minute. What today is
Well,
Tuesday?
it is Tuesday, but even per like some of the emails, so check your emails. I'm definitely emailing you, so pretty pleased. But I am trying my best just to follow up to just again follow the assignment, get feedback from the community based on what you're asking, right? So we're here, and I got my boy David FX for Living helping out to try and answer questions. But there's nothing better than the man himself here, so um, that's what it is, buddy.
Obviously.
The fellow that just made a request or comment and posed it to the community in regard. This is what I thought I heard because I'm walking around the house grabbing blueberries and getting ready to sit down, listen to more of y'all.
Nice.
But I heard, and I may have misheard, but I thought he asked, how do we know when a high resistance liquidity run condition is no longer a high resistance liquidity run condition?
Yes, sir.
Can he confirm that's what
That
that
is
was? Or
indeed exactly what I heard as well. David had his take on it. I had mine, but that is 100% what I heard as well, Michael. So if you
Yep.
have a take on
Yep.
answering it,
That was
okay, give me a second here. The answer to that is number one, knowing where the market is likely to draw to next. Because if it's an obvious pool of liquidity or a single high, relative equal high, a single low, or relative equal low that the market has not spent time gravitating towards or traded to, or for instance, like we used today, which was the regular trading hours opening range gap, high and low level from last Wednesday. That it was such an obvious. It's again one of those things I have on my notepad. I go through and I look at the last week or so of trading. Any relative equal highs from all time frames down. I go through all of them. Like I'll look at weird times, like the 17-minute. I'm looking for refinement of specific price levels. And I like what you said earlier, Kit, where you said that the lower time frames, it does in fact help you zero in on levels that you wouldn't otherwise pay much attention to on a higher time frame. Like for instance, say like the 10 minutes real popular and 15 minutes real popular, or 20 minutes real popular. If you only limit yourself to that time frame, you don't really get the benefit of seeing sub time frame that's whatever you're saying that's your lowest one. Going down to these ultra sensitive smaller time frames really ferret out these clean levels that you don't see them booking price real close to it each time and stopping and not going to it because it's masquerading behind the big candle on a higher time frame, whatever it is that you're using, whatever instrument it is. So by having the clear draw of where it's likely to go, premise linked to a higher time frame, that means a new week opening gap, a new day opening gap, opening range gap, regular trading hours opening range gap. Those are primary, easy. They are always going to be able to be seen in the chart. They cannot hide them from you. The previous day's high, the previous session high, the previous day's low, the previous session low. What's a session low? The time frames I told you to look at intraday. Whatever the highest high and the lowest low are, they're all pertinent. They're all useful. They're salient to what is likely to be used as a next draw on liquidity. The key is knowing which one it just utilized. What did it just use? Did it go to an old high and rip through it and come away from it and start becoming weaker, heavier? If it's done that, first thing is where's the next opposing liquidity? And if there's an obvious, clear-cut inefficiency before getting to that extreme or counterparty, then it's likely to go to that more so than the liquidity because it may go down there and just go into a consolidation. So if there's an obvious inefficiency before you get the opposing liquidity that you're trading within, in other words, let me paint it this way. Let's assume for a moment we use today's NQ's price action. It'll be a lot easier for you all to follow what I'm doing and what I'm conversating about. The 7 o'clock hour this morning, I gave you the 25, 405 and 3/4 buy side liquidity, and then 25,326 and a quarter sell side. It ran the buy side first. going back through that run prior to it reaching up to the high formed at 7:56 a.m. Eastern time, thus clearing the 25,405 and 3/4 buy side. Going back to the left, there isn't any real significant inefficiencies until we get to the buy side and balance sell side efficiency at 7 o'clock a.m. So look how quickly it ran right down into that. It was like a straight beeline right to that. Then it caused that little tiny, like a hiccup, a consolidation. And then it resumed the run on counterparty. It absorbed all the buy side. So shorts are in smart money's favor because they cleared all the buy side. So the ideal scenario for them is to get out below sell side. This is when you anticipate low resistance liquidity run conditions. It will remain that way until the opposing liquidity is taken out. Either it consolidates there or it reverses. If it reverses, you want to see clean price runs where every down close candle, if it's moving up, every down close candle supports price, treats it like a trampoline, gets into it, runs higher. Every buy side and balance sell side efficiency has to stay partially open. If they're closing every single one of them, you're entering potentially a consolidation, or it's going to move into high resistance liquidity run. The clearest, easiest textbook definition is high resistance liquidity run conditions will remain in place until an obvious new draw on liquidity is determined. If it's not obvious on the chart, if you can't see it clearly, don't do anything. If you feel like it's going to go to a specific high or low, or a premium inefficiency or a discount inefficiency, thus giving you some kind of a draw where it likely will go to next, then you have to weigh and measure what is the candlestick delivery doing. By having an open, high, low, close candlestick, you're getting a better read than order flow, depth of market, all that other stuff, because the candlestick will remain open. It won't close inefficiencies if it's bullish or bearish. In deference to direction, let's assume for a moment you think it's going to go lower. The sell side and balance buy side efficiencies, they should not see a full overlap in the upper half to its highest point. If you start seeing these stay open a little bit and price is still gravitating, moving lower, you are in, by definition, a low resistance liquidity run condition. If you're seeing gaps get closed immediately and then the candle overlaps that gap and spends a lot of time in that same area, that is not low resistance liquidity run conditions. It's high resistance liquidity run conditions. So low resistance liquidity run conditions reside in markets that are both determining a clear draw on liquidity where it's running to stop out somebody. Okay, who's the next victim in the room? And this is the key, okay? You have to have both of these. Just one ingredient isn't going to bake the cake. You have to have the delivery in candlesticks showing a willingness to have, when bearish, up close candles, support the idea of lower prices by repelling price away by going into it just a little bit and then sending it lower. That's a bearish order block. Any sell side and balance buy side efficiency when price is bearish needs to indicate some measure of that SIBI staying open in the upper half, not fully closing. But here's the caveat, as I mentioned today. It can go up immediately, fill it in, and that's immediate rebalance. Then absolutely you're in low resistance. The next candle is going to start delivering like rocket fuel, and you just stay with it. Put the trade on, put your stop on, walk away if you have to. Don't be nervous about it. Just let it do its thing, because that is the strongest PD array I have. That's the number one Mac Daddy that you're on side. It's going to deliver. Speed's coming. The direction's right. You just simply submit to it. It won't feel comfortable because it looks like, oh no, that I was expecting this to become a fair value gap, and look, it's already came over top of it. Boom. That's exactly what you want to see if it's going to be immediate rebalance. It ain't going to spend any time waiting around to go down a little bit and then come back up to that fair value gap. It wants to do it right now because it's got no time to be wasting. Gone. That's like a billboard sign for smart money saying, yep, it's getting ready to come right now. Does that make sense?
That's awesome. Thank you, Michael.
That's a lot of gems. Holy.
Yeah, thank you.
Awesome. I'm listening, guys. Continue.
Good news is, folks, this is recorded. So the gems, they are dropping. Let's keep it going. They are dropping.